Welcome to today's deep dive. If you are joining us right now, it's a pretty safe bet that you want your capital to work for you.
Right.
You want to build wealth, you want to be strategic, and you probably already have a decent grasp of the financial markets.
Absolutely.
But even for seasoned market participants, there is this, it's almost a fundamental identity crisis that happens the moment you open a brokerage account.
Yeah, the big question.
Exactly. Are you an investor or are you a speculator? So today, we are taking a look at a fantastic piece of financial analysis titled Investing versus Speculating, Risk and Strategy Distinctions.
It's a really great source.
It is. And the goal today isn't to just, review basic vocabulary. We really want to dissect the mechanics of these two entirely different approaches to the market so you can figure exactly what kind of market participant you actually are.
Or maybe what kind you want to be.
Yes, exactly. Okay, let's unpack this. The core dividing line detailed in the research really comes down to two specific measurable factors: time and risk.
That is the perfect framework to start with, because on the surface, both investing and speculating have the exact same goal.
Making money.
Generating a profit, exactly. But their underlying philosophies are operating on completely different wavelengths. It really comes down to how much risk you are structurally willing to take on and, crucially, how long you are willing to wait for that thesis to play out.
So let's start with the patient side of the spectrum, the world of the investor.
The slow and steady route.
Right. True investing is defined as committing capital with a reasonable expectation of profit. And that is based on thorough research while deliberately taking on average or even below average risk.
That phrase, reasonable expectation, is doing a lot of heavy lifting there.
Oh, totally. It's not about throwing capital at some high-risk tech startup and hoping for a 10x return in a month.
No, it's highly calculated.
And that brings us to the first major dividing factor, which is time. The analysis points out a very specific timeline to define true investing, and it aligns directly with how the IRS categorizes these assets.
Yes, the tax implications are huge here.
To classify as a long-term holding, which is the absolute hallmark of investing, you generally need to hold an asset for at least 1 year.
And that 1-year mark isn't just an arbitrary number. It fundamentally changes the math of your portfolio, which we will get into later regarding taxes.
Right. The IRS wants you to hold on.
Exactly. But while the investor's waiting out that year, or 5 years, or 10 years, they aren't just sitting on their hands. They are relying on 3 main avenues for profit.
So how are they actually making the money while they wait?
First, asset appreciation, so the underlying security growing in fundamental value over time. Second, periodic dividends or interest payments.
Which is nice, just getting paid to hold it.
Oh, it provides great liquidity and compounding opportunities. And finally, the ultimate return of the spent capital when they do eventually sell.
So, to bring that into reality, let's look at the classic example the source gives. A large, stable, multinational company.
A blue chip stock.
Right. We are talking about an entity with low business risk, a massive moat, and a history of paying a consistent annually increasing dividend.
An investor looks at this and sees a machine for compound interest.
Yes. They commit their capital for the long haul to get a satisfactory return. But they don't stop with just one company, right?
No, they utilize diversification.
They buy shares in that multinational, and then they go buy shares in several similarly stable companies across completely different sectors.
Healthcare, utilities, consumer staples.
Exactly. And by spreading that capital around, they mathematically lower their overall systemic risk.
Which is the true hallmark of wealth preservation. And the way we execute this has evolved drastically.
How so?
Well, traditionally, you would use a standard brokerage account. You'd be paying a commission for them to facilitate your trades. But technology has really shifted the landscape toward robo-advisors.
Right, the automated platforms.
Yeah, these aren't just trendy apps. They are sophisticated, automated platforms using algorithms to continuously rebalance a portfolio based entirely on your specific timeline and risk tolerance.
It takes the human error out of it.
It removes the emotion from the equation entirely.
But for those who want to actively manage their own portfolios, the research dives deep into two primary schools of thought for evaluating an asset.
This is a great distinction.
Let's look at fundamental analysis first. This is where you are evaluating microeconomic factors. So like a company's executive management, their debt-to-equity ratio, their supply chain.
All the internal gears.
Right, and macroeconomic factors like interest rates or inflation to determine the true intrinsic value of a security. It's like Opening the hood of a car, taking apart the engine, and deciding exactly what that vehicle is worth based on its parts and performance.
What's fascinating here is how technical analysis completely ignores the engine.
They don't even open the hood.
Not at all. Technical analysts operate on a totally different paradigm. They argue that all known fundamental information is already priced into the asset.
So the earnings reports don't matter to them.
Right. Instead of looking at earnings, they use statistical trends. They look strictly at historical price action and trading volume to forecast future movements.
To use the car analogy again.
Yeah, to use your
Gotcha.
car analogy, technical analysis is like ignoring the engine completely and instead just standing on the street corner watching how many people are walking onto the dealership lot,
What time of day they are buying.
how aggressively they are bidding.
Yeah.
It is all about reading the patterns of the market participants themselves.
That distinction really sets the stage for the other side of the coin. Here's where it gets really interesting. We are pivoting away from the patient, calculated world of the investor and diving into the high-octane world of the speculator.
It's a completely different game.
Totally. Speculating is defined as entering financial endeavors with a remarkably high probability of failure.
Which sounds crazy at first.
It does. But the goal is to capture abnormally high returns. And it relies heavily on short-term market fluctuations rather than long-term fundamental growth.
It is a profound psychological shift. Now, it is very easy to look at that definition, especially the high probability of failure part, and dismiss it as pure gambling.
Right, like putting it all on black at the roulette table.
But there is a nuanced difference in the research. While speculating involves risk levels comparable to gambling, a true speculator is trying to make an educated decision on the direction of a trade.
They aren't just spinning a wheel.
Exactly. They're looking for specific short-term catalysts or technical setups. The inherent risk, however, remains significantly above the market average.
A perfect example of this is the junior gold mining sector. We aren't talking about an established mining conglomerate that pulls thousands of ounces out of the ground every quarter.
No, we are talking about an exploration company.
Right. Over the near term, this company faces a binary outcome. They have an equal chance of either skyrocketing because their drill hit a massive new vein of gold or
Going completely bankrupt because they dug a bunch of empty holes and ran out of cash.
and that binary setup dictates the market participation. A traditional investor will look at that junior miner, especially if there is no current news or cash flow, and they will just run the other way.
The risk-adjusted return makes no sense for a long-term portfolio.
But a speculator thrives in that exact environment. They might buy the stock or the options purely on a hunch or a rumor or a specific technical chart pattern, betting that the upcoming drill results will trigger a massive price spike.
They are hunting for volatility.
But when that hunt for volatility scales up and infects the broader market, the consequences can be catastrophic.
If we connect this to the bigger picture, we see what happens when speculative trading becomes the dominant force in a market. It creates bubbles.
Which we've seen happen over and over.
Oh, constantly. When speculators collectively develop inflated expectations of growth for a particular sector, asset values start to rise rapidly.
And that upward momentum draws in even more speculators.
Exactly. Trading volume explodes, and the price entirely detaches from the fundamental value.
The ultimate historical precedent for this is the dot-com bubble in the late 1990s.
A classic example.
You had internet companies going public with literally zero revenue, let alone profit. But speculators weren't looking at the fundamentals. They were looking at eyeballs and website clicks.
Valuations skyrocketed based purely on the expectation that someone else would pay a higher price tomorrow.
The greater fool theory. And when the music stopped and the bubble burst after 2001, the market crashed. Major tech companies lost staggering percentages of their market cap.
And countless others were wiped off the map completely.
It is a sobering reminder of what happens when a market stops investing and starts exclusively speculating.
Which brings us to the individuals actually executing these strategies today. The speculator's playbook outlines a few specific types of participants.
Let's talk about the players.
You have day traders, who are defined primarily by their holding period or lack thereof.
Right, they don't hold positions overnight.
Never. They open and close their trades within the same trading session. They want to avoid the risk of unexpected news causing a stock to gap down before the market opens the next morning.
And you don't need special qualifications to be one, right?
No. The text points out they are just labeled this because of how often they trade.
Okay, then you have swing traders. They operate on a slightly longer time horizon. usually holding positions for a few days to several weeks.
They are trying to capture a swing in the price momentum.
But regardless of whether they are day trading or swing trading, the tools they use are often much more complex than just buying and selling regular stock. They utilize derivatives and synthetic investments.
The heavy machinery of the financial world.
Yeah, these terms sound really intimidating.
Yeah.
So let's establish what a derivative actually is before we look at the specific types.
Sure.
A derivative is simply a financial contract that derives its value from an underlying asset. So you aren't buying a barrel of oil. You are buying a piece of paper that dictates terms about that barrel of oil.
That is the perfect way to demystify it. And the most common example of this is a futures contract.
Okay, break that down for us.
These are heavily traded on exchanges, particularly for commodities. A futures contract is an agreement between a buyer and a seller to exchange a specific asset at an agreeable price at a predetermined point in the future.
And there's a catch there.
The absolute critical mechanic here is the obligation. When that contract expires, the buyer is legally obligated to purchase the underlying asset.
That obligation is huge. I mean, it makes sense for a cereal company locking in the price of wheat for next year. But for a speculator sitting at a computer desk, they obviously don't want a truckload of wheat dumped on their front lawn.
No, definitely not. They are trading the contract itself, hoping the value of the paper goes up before expiration so they can sell it to someone else.
But what if you want the exposure without the legal obligation? That is where options come into play, specifically put and call options.
Options are all about having choices. It's the right, but not the obligation, to execute a trade.
Let's look at the call option first.
A call option gives the owner the right to buy the underlying asset at a specified price before the contract expires. Think of it like putting a deposit down to lock in the price of a house for 30 days.
Okay, so if the housing market booms in those 30 days, your locked-in price is a massive advantage.
Exactly. But if the market crashes, you just walk away and lose your initial deposit. You use a call when you are speculating the price will go up.
And a put option is the inverse. It gives you the right to sell a security at an agreed-upon price within a specific time frame.
It operates very much like an insurance policy on your car.
Right. So if you buy a put option on a stock at $100 and the stock suddenly crashes to $50, your put option contractually allows you to sell it for $100. You use a put when you are speculating the price is going to drop.
And because you are only paying for the premium of the contract, the deposit or the insurance fee options give speculators massive leverage.
You control a lot with a little.
Yes, they can control a large amount of an asset for a fraction of the actual cost. But leverage cuts both ways, which accelerates that high probability of failure we discussed earlier.
Which perfectly transitions us to the most infamous speculative strategy of all, short selling.
This one always gets people's attention.
Conceptually, short selling is just betting that a security's price will drop. Yeah. But the mechanics of how you do it are fascinating. You actually borrow shares of a stock from your broker and immediately sell them on the open market at the current price.
Hoping it tanks.
Exactly. Your goal is to wait for the price to drop, buy those shares back at the new, cheaper price, return the borrowed shares to your broker, and pocket the difference.
It is a brilliant mechanism when it works. But the structural risk is staggering.
Why is it so dangerous?
Well, when you buy a regular stock, your downside is capped. The stock can only go to zero. But when you short a stock, your downside is theoretically infinite.
Because there's no ceiling on a stock price.
Exactly. Because there is no ceiling on how high a stock price can go, there is no limit to how much it might cost you to buy those shares back to return to your broker.
Infinite risk. So how do speculators even survive in this arena?
They rely on specific risk management strategies. One of the most common is the stop-loss order.
The safety net.
Right. This is a programmable safety net where a trader tells their broker to automatically trigger a sell order the exact second a stock drops to a specific price.
So if a trade turns against them, the stop loss cuts the position immediately to prevent a small loss from becoming a catastrophic one.
It takes a human emotion, that stubborn hope that it will bounce back completely out of the equation.
And what about figuring out when to trade in the first place?
Another heavily utilized strategy is pattern trading. This ties directly back to the technical analysis we discussed. Speculators study historical charts, looking for specific visual formations.
Like head and shoulders, flags.
Moving average crossovers, yeah. Believing that these past patterns will predict future price action. But the data provides a very stark reality check here. The source notes that predicting the future based on past market patterns is generally very challenging to do with consistent success.
So what does this all mean for the actual vehicles we choose to park our capital in? We have covered the theories and the complex derivatives, but where is the foundational money actually going?
Building blocks.
Right. The analysis breaks down the primary investment vehicles, starting with equities. When you buy a stock, you are buying a percentage of equity ownership in a public company,
And a key metric for evaluating them is market capitalization, which is the total market value of all outstanding shares.
which really dictates the ride you're going to have.
Mhm.
A massive $2 trillion mega cap stock is generally going to move much slower than a tiny $50 million micro cap.
Definitely. Then we have funds, which allow participants to buy baskets of assets rather than picking individual stocks. The two titans here are mutual funds and ETFs.
Exchange-traded funds,
Yeah.
let's contrast those.
With a mutual fund, a manager pools money from thousands of investors to buy a diversified portfolio, but they only settle their pricing once a day after the market closes.
Which is perfectly fine for a long-term investor.
But a speculator, especially a day trader, can't use a mutual fund because they need to move in and out of positions by the minute.
That is why ETFs exploded in popularity.
Exactly. An ETF holds a basket of underlying assets just like a mutual fund, but it trades on an exchange exactly like an individual stock,
Its price changes continuously throughout the trading day.
providing the real-time liquidity that active traders demand.
Finally, we have fixed income assets, bonds, bills, and notes. These are debt instruments issued by corporations or governments to fund projects.
The mechanics are entirely different from equities. You aren't buying ownership, you are acting as the bank.
They pay you interest before maturing, at which point the original face value is returned to you.
U.S. Treasury bonds are the gold standard here, maturing over various time frames, like 20 or 30 years, and paying biannual interest.
It is the ultimate vehicle for the patient investor looking for predictable yield. But no matter which vehicle you use, whether you are day trading an ECF or holding a 30-year Treasury bond, there is a silent partner in every single trade you make.
The IRS.
Yes. The analysis provides a crucial section on the tax implications of your holding period, and it completely alters the math of speculating versus investing.
This is where the theories hit the harsh reality of net returns. Your holding period is calculated from the day after you purchase an asset until the day you sell it.
As we established, holding an asset for 1 year or more classifies it as a long-term investment. Anything less is a short-term trade.
And the IRS taxes those two categories very differently. Long-term capital gains are taxed at significantly lower, highly favorable rates to encourage investment and economic stability.
Short-term capital gains, however, are taxed as ordinary income.
You are taxed at your standard tax bracket rate, which is almost always much higher.
This severely impacts the actual take-home profit of a short-term speculator. You might identify a great pattern, execute a flawless swing trade, and generate a 20% return in 2 weeks.
But if you are constantly turning over your portfolio in less than a year, the government is taking a massive slice of your alpha.
The short-term speculator has to generate significantly higher gross returns just to match the net after-tax returns of the patient, long-term investor.
It forces the speculator to be right more often, and with larger margins, simply to outrun the tax drag on their portfolio.
So to synthesize all of this data for you listening right now, the core takeaway from this deep dive is really a tale of two entirely different horizons.
Time and risk.
Investing is a long-term, fundamentally driven strategy for steady growth. It requires patience, thorough research, managing risk through diversification, and letting time do the heavy lifting.
While speculating is a short-term, derivative-heavy tactic, betting on an event impacting an asset in the near term.
It requires constant attention and an appetite for above-average risk. The question you have to ask yourself as you look at your own financial goals is simple. Are you structurally built to be the patient backer of a multinational conglomerate? Or do you have the risk tolerance to hunt for volatility in the junior gold mining sector?
This raises an important question, something that builds on the mechanics we've explored but applies directly to the modern retail environment.
What's that?
In an age where information moves at lightning speed and buying a stock or leveraging a complex options contract is literally just a tap away on a smartphone, does the line between a calculated investment and a speculative bet blur?
Oh, that's interesting.
Does the distinction rely entirely on the psychology of the person tapping the screen rather than the intrinsic nature of the asset itself?
That is a brilliant thought to leave off on. A stock is just a ticker symbol. It's your mindset and your timeline that dictate what it actually is to your portfolio. Thank you for joining us for this deep dive into the underlying machinery of investing and speculating.
It's been great.
We hope this exploration cleared away the fog and equipped you with a sharper lens to view your own market strategies. Keep questioning your assumptions, keep exploring the data, and we will catch you on the next deep dive.